We're focusing today on a frankly staggering headline that's hitting the financial wires. As of this month, October 2025, the U.S. national debt has climbed past $38 trillion.
And it's not just the number, it's the speed. It's accelerating something like $23 billion every single day.
Every day. That pace, it just screams unsustainable, doesn't it?
It really does. And the Congressional Budget Office, the CBO, they've put out projections. They see debt held by the public reaching 107% of GDP as soon as 2029.
107%. Just for context, how high is that historically?
It's actually higher than the peak right after World War II. We hit 106% back in 1946. So yeah, we're heading into uncharted territory since then.
Okay, so our mission today, let's break this down. We need to look at the real costs right now of carrying this much debt.
And then explore what can actually be done. What are the strategies for what economists call fiscal consolidation, basically getting the budget back onto a sustainable track long term.
Let's start with those immediate costs then, because this isn't some abstract future problem. It's impacting the federal budget, well, right now.
Hugely. Take the last fiscal year, 2024. The government's net interest expense, just paying interest on the debt, was almost $880 billion.
$880 billion. Put that number into perspective for us.
Well, think about this. That interest payment just for 1 year was actually more than the entire annual spending on Medicare.
More than Medicare.
Yep, Medicare was about $874 billion. And it was also more than the entire national defense budget, which came in around $873.5 billion.
So interest costs are now bigger than defense spending and Medicare spending.
That's right. It's now the third largest item in the budget. And the CBO projects it just keeps climbing. I mean, potentially eating up all discretionary spending by maybe 2052 if things don't change.
And the markets are noticing this, surely.
Oh, absolutely. We saw Moody's, for instance, recently downgraded the U.S. sovereign credit rating, dropped it from AAA down to AA1.
And their reasoning?
They pointed directly at these persistent deficits, the political gridlock, in actually addressing them. And that kind of downgrade, it can push up borrowing costs, make Treasury yields higher.
Which just makes the debt problem worse, a nasty feedback loop.
Exactly. It really underscores the need to look seriously at solutions, at that fiscal consolidation we mentioned.
So what have other countries done? Are there lessons we can learn from, say, other OECD nations?
Yes. International experience offers some key takeaways. Broadly speaking, 3 things really stand out. First, timing.
Timing, how so?
Consolidations seem to be less damaging to the economy if they happen during economic booms rather than being forced during a recession. Makes sense.
Okay, that makes sense. What's the second key?
Pacing. It seems like gradual, sort of phased-in adjustments tend to work better over the long run compared to really massive sudden cuts or tax hikes all at once.
Gradual is better than shock therapy.
Okay.
And the third?
The third is composition. This is where it gets a bit more complex. It's about what you change, spending or taxes.
Right. What's the general view on that?
Generally, the finding is that spending cuts tend to slow down short-term GDP growth less than equivalent tax increases do.
There's always a but, isn't there?
Yeah. It really depends on the type of spending cut or tax increase. For example, cutting public investment spending can be pretty harmful long-term. On the tax side, raising less distortionary taxes like consumption taxes or maybe carbon taxes seems to be, economically preferable to hiking income taxes.
Okay, so spending cuts might be slightly less painful short term, but it depends what you cut. And on taxes, which taxes you raise matters a lot. How does this apply to the U.S. specifically? Are we typical?
Actually, not entirely. The U.S. generally has a lower overall tax burden compared to the OECD average.
Lower taxes overall.
Yeah, especially when you look at things like consumption taxes, sales taxes, VAT, and also energy or environmental taxes. We rely much less on those than many other developed countries.
So what does that imply for consolidation here?
Well, economically speaking, it suggests the U.S. could potentially lean more heavily on raising some of those less distortionary taxes as part of the mix. More so, perhaps, than countries that already have high consumption taxes.
But politically, raising consumption taxes or energy taxes, that sounds like a really tough sell in the U.S.
That's precisely the tension. You hit it right there. There's also a distributional aspect. Studies often show that consolidations focused purely on spending cuts tend to be regressive. They hit lower-income households harder.
Whereas tax-based measures,
They can also be designed to be more progressive. So the economic analysis might point towards a gradual plan, maybe leaning more on some targeted revenue increases.
but the political reality is a huge hurdle.
It absolutely is. There's no easy path here.
So let's bring this back home for you, the listener. Why does this matter so much? What happens if we just, well, don't act?
The consequences are pretty stark. This funding debt acts like a drag on the economy. Fiscal drag, they call it. It can crowd out private investment, slow down overall economic growth.
And potentially increase the risk of a real fiscal crisis down the line.
Yes, and that erodes confidence. Confidence in the U.S. economy, confidence in the U.S. dollar as the world's main reserve currency. The stakes are very high.
Which leads us to a final, maybe uncomfortable question for you to think about.
Right. We know that the big drivers of future spending growth are projected to be Social Security and major healthcare programs like Medicare and Medicaid. Federal outlays are projected to hit over 26% of GDP by 2055, largely because of these programs.
And we've just discussed how difficult tax hikes might be politically, even if they are part of the solution.
So the question becomes, what actual trade-offs might the U.S. need to seriously consider when it comes to these major entitlement programs? Things like perhaps changing eligibility ages, maybe adjusting benefit formulas.
Tough choices.
Extremely tough choices. To find a credible long-term path to fiscal sustainability, these might have to be part of the conversation, even though every single option carries, a significant political cost. It's a debate we simply can't afford to ignore.